Okay, hello everyone. As promised, I'm gonna hopefully try to get this show, I mean, this recording um, about hedging and hopefully show you guys how to hedge uh, in case of a market correction or market crash. I don't, to be honest, I really don't think we're gonna have a crash. But that's just my opinion at this moment. We might get into a heavier correction, but at this time I don't see it. Okay, but you never know, and so this is what this video is for: is to help you hedge on those bad days. So first and foremost, I'd like to apologize. Kayan xin lỗi, muốn các bạn thông cảm cho. Thì Kayan không có nói tiếng Việt rành ha. Nói thì cũng ok thôi, nói bình thường. Tiếng mấy cái từ khó thì không có nói được, chỉ có nói cho nói thôi, chứ còn không có cái gì hơn. Thì tiếng Việt của Kayan rất là elementary. Cho nên xin lỗi nếu mà các bạn nào mà có thắc mắc hay là có muốn câu hỏi gì đó mà không hiểu cái video thì xin viết cái comment underneath and hỏi ha. So please ask any question that you don't understand. I'm gonna go as slow as I can to explain everything that I can, so that you all understand. I want to move this video quickly, so I don't want to take too much time. I don't want you guys to waste an hour of your time watching this video. So I'm gonna do it as best as I can, and so English will be the best way for me to express and to say what I need to say without doing a lot of because I'm trying to think of the word to say in Vietnamese. So I'm not gonna do that. I'm not gonna go into Vietnamese and get this thing going. So today in front of me I have Thinkorswim by TD Ameritrade, which is my go-to platform right now, although I've been trying to change, but just I have no time. So a lot of platform I'm not used to it. I tried Interactive Brokers, but their platform wasn't that good. So or maybe I'm just not used to it, but I'm just gonna stick with this for now and see what happens. Okay, so without further ado, let's get on with this hedging. So today I have on demand. Okay, now I use Thinkorswim and I use Tasty Trades. Now I don't use Robinhood. I've never been with Robinhood. For the past 11 years, I only use two platforms, which is Thinkorswim and Tasty Trades, and so I'm very used to these two platforms, and I can pretty much understand it more. So I'm sorry if your platform is a little different, then you just got to understand it a little bit more. Okay, I do not trade on mobile. I don't believe in mobile. I am very technical as far as trading is concerned. I do trade within charts. I am a option seller first and foremost. I don't buy often. I do buy, but I don't buy much. I do sell. I sell a lot of option selling. When I buy option, it's all about momentum. It's about breakout, high of day or high of all-time highs, things like that. So basically a pure momentum play. I will buy, get in and get out weekly options. So if it's today, I'm going to jump in. If I feel that Tesla is going to bounce, I'm going to jump in, make a quick scalp, 10-20%, and I'm out. Okay, so that's the stuff that I do. But longer term, I usually swing trades. I do selling. I always sell option mainly, and so and I also have income strategies and things like that. We can get into it down the road if I learn how to do live streaming or video. This is, to be honest, this is my third video. I've done the last two. It was horrible quality, so I'm hoping this third one is better quality. So we'll see what happens. I've deleted the last two already, so third time's a charm. So in front of you, I have the option chain pulled up, and I'm gonna buy. Most of you have Tesla, so I'm gonna buy Tesla here. Again, this is on demand, so I can rewind time. Okay, I can go back in time. So I'm gonna buy Tesla here, and if you want a quick fill, you just click ask to buy, and then come down here and confirm and send. And usually you get a fill right away. But if a stock price jump really quick, you might not get filled. So you can just cancel, undo the lock icon, and then just jump in and buy again. So just a quick, gosh, it's not filling for me. It's probably moving up higher. So let's try a few times. So anyways, I'm just gonna do market order so that we can get this filled. I'm not gonna sit here and wait for it to fill. And it's not filling, even at market. What is going on? You're kidding me. There it is. Okay, so we are in. Whew. So I just bought 100 shares of Tesla at 442.22. Okay, and this is back in August 31st. So that's basically the first day of Tesla split. So the reason why I did this is basically we're gonna go back in time this past week to show you how we could have hedged and how you can hedge in the future if something like this ever happened again. But right now we're gonna let this run. I'm gonna explain a little bit of a few things for us so that we can understand. Let's go back to basics right now, okay? So that some of the newbies here will understand a little bit of what basics option. Here we call this an option chain. You have the call side, you got the put side, okay? So very basic, call, puts. Now, if you see this purple area, this is called in the money options. This black area is called out of the money option, okay? In the money, out the money. In the money has intrinsic value, and out of the money have extrinsic value, no value. Okay, you have in the money or in value, so intrinsic value, extrinsic value, zero value, unless Tesla pops to your strike. So say if you buy a 465 strike, if Tesla gets to 470, you're now intrinsic or in the money. Okay, remember, in the money. Now, if you look at this, Tesla right now is 446. This is called at the money. Okay, both of these options is called at the money because Tesla is ranging right here, right now, between these two prices. So this is what we call at the money. So if I ever say ATM, ITM, OTM, you understand what these means, right? So OTM, out of the money, ITM, in the money, ATM, at the money, and so that's what we refer to, okay? Now this is the put side. Put side, same thing, it's the reverse. In the money, out the money, or at the money. Okay, so let's just get that out of the way. Secondly, is if you see this here, this is some of my layouts. The delta, the gamma, the theta, the vega, implied volatility, volume, and open interest. Why these are important? Because it tells you your option, what it's doing. Up, down pricing, okay? Or the decay value of your option, okay? So first and foremost, let's get into the delta. What is delta? What does this explain? Okay, so delta is the price movement of your option versus your stock. So for every dollar the stock move, delta represent how much the option move. So for instance, if you do a $430 strike, for every dollar the stock move, your option moves 67 cents right now. Okay, so that's not bad. So as you can see, it moves 66 cents per dollar. But the best part is you're only paying $3,100 per 100 share. Now again, each option contract has 100 shares. One option contract has 100 shares. Okay, so you're gonna pay $31 times 100. You have $3,100 basically for 100 shares at $430. right, is much, much cheaper than you would buy Tesla for. 31,000, right? Look at this. I mean, if I times 441 times 100, right? 44,000. My buying power is 31,000, but it's 44,000. So you see how cheap it is, right? And if this, and basically, if Tesla moves up, I make 65 cents per dollar. The more Tesla move up, the higher this delta gets, right? So again, every delta has an expiration date. And here's the big kicker, is theta. Theta means time decay. For every time, every hour, every minute, every day, you lose value. Okay? You lose value. So being an option buyer, there's not much benefit other than if you buy deep in the money or deep out of the money and hoping that the stock just spikes. Say for instance, if this 780, if Tesla hits 780s, I'm probably gonna make thousands of dollars for 26 cents or $26 a contract. Okay? But it has to go there really quick time. Okay? Because this option will balloon. But if it doesn't, by expiration, by September 4th, anything out of the money from here on down is zero. Completely zero. And I'm going to repeat that again. Zero. No value. Okay? So when buying option, it's not good to hold. So buying option further is better. Of course, say if you buy November, is much better. But the value doesn't move as much. As you can see, Tesla's been moving. You see these hasn't jumped much. See, it barely jumped. You just saw a splash there. But these one don't jump much because the time is not there. So it moves little. It will move, but it doesn't move as much. I mean, with Tesla, everything moves, right? But here, look at this. Every time Tesla move pricing, this will move. Pure and simple. It's quick because it's about to expire. Okay? But remember, all this from here down is all worthless at expiration. Zero. Now, volume and open interest. You want this, okay? The reason why you want to keep an eye on this is if you buy an option that has, look at this, 4 contracts just opened today and no, I mean, this is on demand, so it's not up to date. But imagine if you buy a contract and there's nobody in it. Do you think if the market tank, you think you can get out of it? No, because no one's buying your option. No one's gonna buy this. So you're gonna sit there and get stuck, and it's gonna go, and you just keep on going down and down and down in value because you can't get out. No one's jumping in to rescue you, to buy it, while you're trying to sell it. So again, always pay attention to the volume and open interest. Open interest means the contract's already there, it's already purchased. Volume mean is today and today only. Tomorrow this is gonna change. Okay, tomorrow what here will add on to the open interest. Okay, so this one 4,680 and this one 0. Tomorrow's gonna be 4,680 open interest, and then it's gonna start at 0 again on the volume. And then as more people buy for that day, this will go up. Okay, so very simple. Make sure you pay attention to this. Make sure you pay attention to delta and the theta. Those are very important. IV as well. IV's good, but I'm just gonna skip all this right now. We're gonna talk about hedging because time is moving and I want to get this video out to you guys. Now, here's one way of hedging, and also one way of making or creating an income. Okay, again, an income. Because this is a great strategy that I do on my 401k, I mean my IRA, and you could too. You can do this as a mean of income. You can make really good income every single week. And basically right here, I'm going to say, hey, Tesla by Friday is right now at 440. I don't think it's going to go to 500. Now, I would never do this to Tesla. One stock that I won't do because this thing can jump crazy. So with Tesla, it's hard to do a cover call because it can shoot one way or another, and if it shoot the other way, you will make money, right? But you're not gonna you're not gonna make as much money. But let me just give you an example. Okay, so right now we're gonna sell the 605 what is it, the $500 call. Okay, what happened? I clicked the wrong. Okay, here we go. So this is one way. It's not a hedge, but it's a one way to also hedge on top of what we're gonna do in a second. But 500 call right here. By the end of the week, I don't think Tesla's gonna get to 500. So I'm gonna click sell to open, and I'm gonna sell this. There it is. So I got in at 562, which means by Friday, and right now it's the 31st, which is Monday. By Friday, if Tesla don't go above 500, I'm gonna make $562, because remember, theta decay. If you're a seller, you want this to go to zero, right? So the option that you want it to go to zero. The lower it gets, the more money you make. And of course, again, by expiration, everything out of the money becomes worthless or zero. So if Tesla were to hit 500 or 501 cents, I will be in the money, which means at closing, at the bell, ding, 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 that is the recording price. So if Tesla become 500, anything above 500, a penny above 500, I will be in the money. Anything below $499.99, I am clear. Okay, so keep that in mind. So if Tesla is above 500, I'm gonna get assigned this call at expiration. But don't worry, this call is gonna be assigned, and I'm gonna be basically what is called a short seller. I'm gonna own 100 shares of stock. Remember, each contract is 100 shares. Okay, at expiration, if Tesla is above 500, I'm gonna get this thing assigned 100 shares. I'm gonna be short shares though. However, I have 100 share long. You cannot have a long and a short together. So guess what happened? Both of these gets called away. Okay, it washes this out. I will make the full $562 I get in credit. And if Tesla becomes, say for instance, whatever the price of this is at closing, so $500, so you're gonna make the difference of $500 in some sense. Let's say 500 minus 442, right? So you get $58 times 100. So you make money, and you also make money on this credit. So it's a win-win if Tesla is above your pricing. But if it's below your pricing, you still keep your shares. You get to keep this because this is completely worthless. It's zero, right? So you're gonna make this along with this that you're gonna get to keep. So now the call is gone, your share's still there, then you do it again next week, and then again next week, and again next week. This is called an income strategy, a covered call that you're gonna keep on doing and doing. Now I know a lot of people message me and say, hey, I'm down 20%, 30%, 40%. Should I cut loss on my stock? Should I cut loss? I tell them, listen, you never know when your stock gonna bounce back, but if you cut loss today, that money is completely gone. You can't get it back. Now say for instance you sleep and you wake up one night and your stock jumped 20%. Well, guess what? You have a chance to recover your stock. You can continue to hold your stock and do that. And guess what? If Tesla becomes over 500, I can simply let this expire and let both of them get called away, or I roll this position to next week, or a monthly option, and let it do it again and again. So I don't have to worry to let go of my long stock. I just roll this and collect more credits. So it's okay, right? Because this is an income strategy because you don't want to let go of your stock. So you can do that. That's one. This is one way of hedging your position. I mean, remember this. When you sell option, the most you can make is what the premium you receive. So all this here, when you sell, this is all you can make, right? So if you sell a 455 strike, you can only make $17.25 per share. That's $17,000. $1,700, sorry. Right? $1,700 you can make if Tesla does not reach this price at expiration. How's that? That's pretty good, right? But if you don't have the stock and Tesla shoots up, short call is unlimited risk. It can go forever. Tesla can shoot to 2,200. Say for instance, a month ago when you sell a 500 call and Tesla went to 2,200 and you never cash out, you would have lost your socks. I mean, you would have. I don't know. I mean, I would hate to see another, Robin Hood case with that kid seeing the negative value and kill himself. But that's crazy. Okay. Anyhow, again, that's why you want a covered call, because when it shoots up, you have the stock to cover you. So I'm not gonna get into it too much. We're just gonna kind of, that's one way of hedging. Another way is also we call it a collar, okay, or you can also do a ratio spread. But we're not gonna get that into that. Let's talk about how to really hedge a position, okay? But if you can see this, by the end of this video, I'm going to go back to see how much we made from here, okay? From that short call. So let's get into the hedging. Now, remember what I said about the delta. When you want to hedge, you're going to hedge an 85 delta. That's the best delta to hedge, okay? Reason why I say that is, if we hedge 85, now let's move this to the 2nd of September. This is this is when everything's starting to kind of break down a little bit, right? This is the day when the market kind of gave us a signal that we might be in a sell-off. So I'm gonna forward it to September 2nd. As you can see here, we are there now. Tesla's down $32. We're gonna say, hey, we're scared. Now you can hedge individual position that you have. So if you have Apple, you can do Apple. You can do Tesla individually, or if you have a small account, you can just do the Qs. Since tech is selling off, you can do the Qs. Or you can do the SPY, right? These are hedging that I'm about to talk about, but you can do index, right? Options, so that you can hedge your position if you have a smaller account, or you can buy more, basically. And then let me just show you here. So to hedge, we're gonna do. Let's go here. You don't want to hedge a few days into expiration. You want to give some time. I would recommend maybe September 18th, but now next week we're getting closer, so I would consider doing an October. But right now let's just talk September 18th as our next position. So when you want to hedge, you want to hedge an 85 delta. Remember what I said about delta? Okay. So we're going to go in and look for an 85 delta, which is right around here. I usually look for a more solid number, round number, and a larger open and volume. Okay, remember what I said about open and volume. These are very important because you want to get in and get out. So I'm looking for something that has volume. Okay, so the 600 looks good. So I'm going to do here. That's about 85, 82 delta. Now look at this. Okay, when you hedge, you remember you want to buy in the money puts. Okay, I'm going to do this and I'm going to analyze it and I'll show you. Look at this. If, say for instance, Tesla dropped to $300, look at this. You make $13,071. Wow, almost 3,100, right? And this is an 85 delta. Look at that. Now, if we go to a 90 delta, look at this, 700, right? 700 strike. Let's change this to 700, and look and see if you can make any more money. At $300, you make $277 more. That's it. $300 more. $300 more. But look at this. 90 delta. You pay. This is $267. This is $171. That's almost $9,000 difference that you're gonna have to put into it. Now, $171 times 100. Remember, 100 shares. It's one contract. So you're gonna pay almost $10,000 difference to make $300. If Tesla dropped to 30 or 300, that's crazy, right? Now look, let's do 100, almost 100 delta, a dollar for dollar, right? A dollar for dollar, and see if that's gonna make us any difference. Look at this, $300, $500. You only make $500 difference, but look at this, 170 versus 363. $200 difference. That's $20,000 difference to make $500 more. Are you kidding me? That's now look. Let's do a 75 delta, right? $550. Look at this. I'm gonna change this. Where we at? Yeah, 550. Okay, 300. Look at that. $500 less. You make $500 less than what you should have. Actually, $700 less. But look at the premium. It's not that much difference. 550 is 138. 600, which is 85 delta, is 170. So it's $3,500 difference. Trust me, you want to do the safest is from 80 to 85 delta is the best delta. So why I say 80, 85? Because you want to look for this. You want to look for volume and open interest. You want volume because you want to get in and out. If it goes the other way, you want to exit, right? So secondly is you want to look at a round number. And what's round number? 600, 575. See the volumes difference? Or anything that you can see that have more volume. So from 80 to 85 delta is where you want to land. Those are your best spot. You come in. So we're gonna do this. We're gonna buy. And right now we're about 11 a.m. Now remember, I trade in Pacific time zone. Yours may be Eastern, Central, Mountain. I don't know what your time zone is. Mine is Pacific. My trading hours are 6:30 a.m. to 1 p.m. and that's it. So right now I'm at almost 11 a.m. and I'm just gonna go ahead and buy a $600 in the money put, okay, as a hedge, because I feel this market's gonna crash or correction or whatever. I'm gonna do it, right? This is how we hedge. We don't have to plan ahead. If the morning you come in and everything's red, you can jump into this, and if it spike out, you get out. Take a small loss and get out. Okay, so I'm gonna just go ahead and purchase that. Oh, we filled. So I bought a $600 put, deep in the money put, one contract. Trading price is $170 or $17,000. Okay, but here's the best part. If Tesla dropped to 300 or even anything, okay, so I'm gonna forward this in time. Look at this. actually. There it is. I'm gonna go and do 1254. Actually, I might talk a little bit much, so I'm gonna do 1234. Okay, so give me some time. Okay, so we will see what's gonna happen to Tesla. Now, unfortunately, I don't have September 4th, so it's grayed out. So I can't show you the full when it expires, but at least you get an idea. Look at this. Tesla dropped $44, is at $400. Look at this. I'm only down $200, right? And because I also have the call, that also make me money. And look, I'm already up at $537. So it's almost basically 100%. I only got 24 cents left to go. So I'm gonna cash this out no matter what, right? And close this out. Doesn't matter. I'm already up. So forget about this for a second. Look at this. Every week, if you can do this, you make $500 extra a week while you still own your shares. This is an income strategy that I would love to teach everyone how to do. And we can just rinse and repeat this every single week. You don't even have to trade anymore. Don't even have to worry too much about it. You just do this. And if you wake up one day and you see everything going nuts red, you go and you hop onto the position and you buy an 85 delta put. That's it. To hedge your position. You still hold this because you're going to make 100% on this. You don't want your stock to go more further, so you buy an 85 put. Guys, this is the best hedging strategy that you can do, right? And if it doesn't work, you exit, take a small loss, and get out. I see people cut loss in $10, $20, $30,000, and they cut loss, and then come to find out, a month or two later, their stock go way past it and go way back up, but they're no longer in the position because they cut loss and they got scared of getting back in. It's mentality that will kill you, right? As a trader, you trade. For me, I don't trade on emotions. I leave that. I wake up and there's no emotion. I'm a robot. Okay? You trade like a robot, but unfortunately, we can't. We are human beings. We have emotions, and emotion kills us in any stock trading. So basically, you see red and you're like, oh my god, what am I gonna do? Cut loss. I get so many messages every day. Should I cut loss? Come on, guys. So many people on Facebook. Oh, cut loss. Market's gonna crash. Those are noise. I don't listen to those. Okay? And I don't recommend you do either. You trade like a robot. And you constantly trade like a robot. And that's all you do. Leave your emotion aside. Most of you trade and you predict already. That you came into the stock and you say, okay, I know today Tesla's gonna go up. You hop in the position and Tesla go up a little bit and then drop. And the first thing in your mind is, oh my god, it's gonna drop more. So guess what? You get out of the position. And a few minutes later, exactly what you thought. The stock goes straight up and more. Instead of you making 1,000, you lost 500. That's a $1,500 swing, right? Why? Because we trade with emotion. We're so emotional, right? If we have a clue of, okay, today the market's gonna be green. That's why when you get into position, you know your target and your exit. Your exit's how much percent down. That's your exit. And your target, you know that, say Tesla's gonna reach 425 today. You get in, you get out right around there. And you wait. If it hasn't hit your target of exit, you just wait. We, as traders, we just sit there and we're so emotional. We see a little bit down and we're like, oh my god, it's gonna go further. And then we exit. and boom, you lost money because the stock went straight up. So again, try to trade like a robot. And if you need to hedge your position, remember 85 delta. 80 to 85 delta is your best friend. Get in, buy long, okay? If it doesn't work, you get out, and that's it. That's how you hedge. And you can, sometimes, you buy it before closing, and thinking the market's going to go down, and next morning, Tesla shoots up 30, 40 points. Well, you're going to take a pretty good chunk of that. But at least you slept pretty good at night, because of the fact that you have your position hedged in this wild, crazy market right now. Okay, look at this. Look at all this red. And we're not even talking about Friday right now, right? So, look, I'm $200 down. Without this, I'm $3,000 down, $4,000 down. Right? So think about that. Okay, 85 delta is your friend when the market goes down, go up. Now again, you option buyers, be careful for theta. All this is gonna be gone, zero, zilch. So again, I'm not gonna say any more than that. Okay, most of you guys always buy so far out of the money. Guess what? If Tesla never reached there, or if any stock never reached there, everything go to zero. So if you're gonna buy way out of the money, that's okay. But you need to do leaps, way out. These are called leaps, okay? It's at least 6 months or above. All these are leaps. Buy it. That way, at least you give yourself time for it to go up, or else you're gonna be done, okay? So I'm gonna leave you at that. Just to recap, we can hedge our position by selling a call, out of the money call, because you don't want your stock to go to, and your option to be taken away. Okay, so because anytime that your option is in the money, remember, when your option is in the money, you will get assigned. No matter what happens, you will get assigned. And when you get assigned, you're gonna get your shares taken away. Okay, so if you don't want your share get taken away, you either buy a little bit out of the money, right? So monthly options are basically the third week of every month. Okay, so you sell out of the money calls, and these are out of the money, and you predict. You need to know your expected move for Tesla for this week. So if you don't think Tesla is going to reach 500, you sell 5 right here, September 18th. Okay, that's a lot of time for you to go, okay, what's Tesla going to do? Now, every stock's going to go up, go down, go up, go down, go up, go down, right? So, okay, stock's going to go up, go down, range here. It's a big range here, So, as you can see, we don't know what's going to happen on the 18th, so we give ourselves enough time or enough strikes. So, say 600. You still make $460 if Tesla don't reach here in 2 weeks, right? And if you get more risky, hey, look, Tesla's not going to reach 500 in 2 weeks. I'm going to make $1,200. You can do that. You can sell calls, right? It's one way of hedging, but it's not, because remember, you can't make unlimited. When selling option, the most you can make is what you see here, okay? But when you buy an option, it can go to the moon. So that's why people buy option expecting a big move, but you have to also account for theta, for delta, okay? Because it can get crushed. So that's pretty much it, guys. I mean, you can do a caller. A caller basically is a covered call. So you sell one here, and then you buy a put. You buy in the money put, or out of the money. In the money is better. So you buy in the money put, And this is basically, this is a collar right here. This is a collar. Okay? Without this, it's just a hedge. Basically, all this is a hedge, but this is a collar. Deep in the money collar. Look at that. But forget this for now. If you have stock, you can go ahead and hedge your position by doing an 85 delta. Now, if your account is small, as I mentioned, you can do the index, the QQQ, SPY, SPX. You can do those, right? You can sell, you can buy deep in the money calls on these. Now, I wouldn't do SPX, it's too expensive. But SPY and Qs, look at this. Okay? If you think Qs drop, right? You go here and you look for an 85 delta. Look right around here. Okay? I'll do a 300's a little low, 75 delta. So I'll do about 310. Okay, remember this. Now this is on demand, so this is not accurate. But I'll do a 310. Right? A 310 and times, you can multiply that. Say you have your portfolio is around $10,000-$20,000 that you're trying to protect, right? You do 5 contract, 2-3 contract on this, right, to protect it. So let's go back. Let's just go back to the second. Okay, so on the second, okay, 315 is perfect. No, actually, sorry. I'm trying to look at this, but these are not. Anyways, we're gonna do 320. Okay, look at this. I'm gonna do deep in the money, $1,800, right? And say you're protecting a $10,000 portfolio, right? I'll do 5 contract. That might be much. Actually, you can only, if it's 10,000, honestly, look. $21,000. Okay, so right there, 10,000. So 3 contract. I'm protecting 3 contract. Now you can get in and out of this pretty quick. This is September 18th. Okay. There it is. So let's just do this. Okay. Now we're gonna forward again. And we'll see if we make money or lose money. Right? Look at that. You're protecting yourself. Right? Look, today minus $16 in the Qs. You made 5,000 here, you protect half of it already. Right? Again, you can do 5. But 1,800, that's quite a bit, right? But that's depending on your account. You can do one, you can still protect it a little bit. But look, the market's down, I'm up huge. Right? And if anything, you can get out. Hop out. Market change on Friday. Remember how I post up, I said, hey, we're gonna see a rally, and we did. You get out. You take your profit, you get out and see if that's correct. And if it start pulling back and you see more, you hop back in. Right? I mean, yeah, some of you don't have day trade account, so you may have to hold. But again, it's a great way to hedge. And if the stock go up, yeah, you're gonna lose a little bit, but we're not in a clear yet. So you want to hold? Yeah, I'll hold. But this is a great way to hedge. You can always get in and get out. Right? So the video's gotten a little bit long, so I'm gonna start ending it here. But if you have any question, please comment below. Remember 85 delta. We're gonna recap this. 85 delta is your best friend. Okay, right around there's right around the 85 delta. This is my layout. I have all this because I use this on a daily. Okay, So remember, 85 delta. And you can also sell out of the money calls to make a weekly return, a monthly return. Guys, it's a great income strategy. I do this for my IRA. So, you know, I can tell you I can probably make an average weekly of about $1,200. I'm just being honest. Okay, so, but my IRA is pretty big, so, but you can make this money on a weekly basis, right? You don't need to own a lot of shares. If your shares get taken away, you do it again, right? Because you still take advantage, remember, of dividend. So if I do Apple and dividend X date's coming out and they're gonna drop, doesn't matter. Let it drop. Because if it dropped, it means my option dropped, and I make the full credit on the calls, and I sell another call next week, and next week, and next week, and next week. You want to do these on the best stocks possible, because the better ones are the ones that move very little. Discover Financial, Wells Fargo, Chase don't move a lot. Disney don't move a lot. Boeing don't. Well, Boeing kind of, it does move, but Apple, or anything that moves forward, I mean, there's so many. I can name a ton that you can do just income strategy and make money week over week over week over week over week. So that will be another video for down the road. But for now, to hedge, you want to do an 85 delta in the money put. Okay? That's it. Very simple. I know you guys, a lot of you guys, judge. Oh, I'm going to think, okay, the Q's going to go down to 270. Let me buy 270. And you don't make nothing. You make nothing. This is a 26 delta, guys. It goes 26 cents per dollar. And sometimes it doesn't move because of decay as well. So, again, do an 85 delta. Hedge your position. You can get in, get out. And that's it. Sleep better at night. Because you can actually fully recover your account. As I said before, look at Tesla. If it go down to 300, let's do the math, right? I bought Tesla at 442 right here. If it goes down to 300, I lost $142 a share. So I'm gonna times 100. I lost $14,200. $14,200, right? But look at this. Okay, let's remember I said Tesla gonna drop down to 300. Look at that. Right now, currently, you will be at $10,000. How much do you almost fully cover? Right? You almost fully recover. Isn't that amazing? So, if you do, say for instance, some of you will go, oh, 300. So Tesla gonna go 300? Yeah, you're gonna make a lot of money if it dropped 300. Check it out. Right? Okay? If Tesla actually does drop down to 300, where am I at? Am I on the right day? Okay. So, we're here. Tesla's here. Look at this. You make 2,300. That's it. That's it. You make more as it goes more. But again, do you think Tesla gonna drop? You never know. if Tesla's going to drop 300. But you do know that 85 delta, you can buy that and hedge it that way. Okay? So let's end it here. It's getting 50 minutes. Sorry. It's getting a little long, but any question, feel free to ask. Write down in comments. This is a great way to hedge, guys. Great way to hedge. And so hopefully I helped some of you guys, and we'll see you next week. Okay? Have a great rest of your night and rest of your long holiday weekend, and we'll go from there.